A dealership told Ethan he was getting the car at cost, $50 above invoice. The salesman even said they were losing money on the deal. Ethan drove home in a brand new car thinking he'd won. He didn't. The dealership made over $3,000 on him, and he never saw a single dollar of it. Now his neighbor Mark saw the car in his driveway and loved it. The next weekend, he went to the exact same dealership for the exact same model. Mark paid $2,400 more. Same car, same dealership, same month. The difference wasn't the car. It was what they said when they walked in. There are 14 hidden profit layers built into every car sale. Most buyers don't know about any of them, but the one that costs you the most money, it's not on the sales floor. It's in a room you walk into after you think the negotiation is already over. Professor Wealth ran the numbers on all 14. Here's what he found. Ethan wanted a new car, not some impulse decision. He'd been planning this for months. He pulled up Consumer Reports, found the manufacturer's invoice price, and walked into the dealership knowing more than most buyers ever do. The sticker price on the car he wanted, $32,250. The manufacturer's invoice, the price the manufacturer charges the dealership for the car, was $29,900. Ethan negotiated for over an hour back and forth. The salesman made it feel like every dollar was a battle. And by the end, Ethan got the price down to $29,950, just $50 above invoice. The salesman leaned back and said they were basically losing money on the deal. Ethan drove home feeling like he'd beaten the system. And honestly, if the only profit layer was the visible one, the gap between what you pay and the invoice price, he would have. $50 in gross profit is almost nothing. But that's the thing. That $50 is the only layer you're allowed to see. It's the number on the surface. Underneath it, there are 13 more layers of profit, all invisible to you, all built into the structure of every single car sale. Now, a week later, Ethan's neighbor Mark pulls into the driveway after work. He sees the new car, walks over. What is that? A Camry? Loves it. Asks where Ethan got it. That same weekend, Mark heads to the exact same dealership and asks for the exact same model. He walks out paying $2,400 more than Ethan. And he thought he got a fair deal too. We'll come back to Mark. But first, you need to understand what Ethan didn't see because the same invisible machine ran on both of them. Let's start with Ethan's Consumer Reports data. It showed him the manufacturer's invoice, and that's useful. At least he knew the baseline. Most buyers don't even have that. They walk in with a number in their head, and if the dealership hits that number, they feel like they won, even if the number has nothing to do with reality. But here's what that report doesn't show. The manufacturer's invoice is not the dealership's actual cost. The real cost is lower, sometimes significantly lower, because of private financial arrangements between the car manufacturer and the dealership. These payments never appear on any consumer report. Not Consumer Reports, not Edmunds, not Kelley Blue Book, not TrueCar, none of them. The first hidden payment is called the dealer holdback. After the sale, the manufacturer sends money back to the dealership, usually 2 to 3% of the list price. On Ethan's car, with a $32,250 sticker, a 2% holdback means the manufacturer sent the dealership an extra $645 after the sale. At 3%, that's $967. So Ethan thinks the dealership made $50 on him. In reality, the holdback alone put them at 12 to 19 times that, and we're just getting started. Next is what's called a dealer cash incentive. If the manufacturer overproduced a certain model and needs to move inventory, they pay the dealership a bonus to push that specific car over others. You'll never know if the car you're buying has one of these attached to it. Then there's the volume bonus, sometimes called a stair-step bonus. The more cars a dealership sells, the bigger the bonus. Hit a certain tier and every car sold in that period earns an extra payout. This, by the way, is why dealerships get more flexible at the end of the month and the end of the quarter. They're not being generous. They're chasing a volume threshold that could be worth tens of thousands of dollars across their inventory. After that, there's a regional dealer-only rebate. If a specific region is struggling, too much competition, slow sales, economic conditions, the manufacturer can step in and offer the dealerships in that region an additional incentive to move cars. You'd never know this exists unless you worked at the dealership. And finally, on the front end, there's floor plan assistance. When a dealership receives a car from the manufacturer, they have to pay for it, usually with a loan. That loan has interest. Floor plan assistance means the manufacturer helps cover that interest cost. It's another hidden subsidy that reduces the dealership's true cost below the invoice price. There's one more category. Back-end incentive programs. These are payments tied to customer satisfaction scores, brand protection metrics, service quality. They're not directly tied to individual car sales, but they're another channel for money to flow from manufacturer to dealership. Now here's what makes all of this almost irrelevant. Even if you could somehow calculate the exact value of every single one of these hidden layers and use it in your negotiation, that's still not where the real money is made. The real money is made in a room you haven't walked into yet. Before we walk into that room, let's ground this in real data, not estimates, not guesses. Real financial statements that anyone can access. Some car dealerships aren't small family operations. They're publicly traded corporations with hundreds of locations. Companies like Lithia Motors, which operates over 324 dealerships in the US alone, AutoAtion with over 300, Penske with over 200. Because they have public investors, they're required to file detailed financial statements showing exactly how they make money. And those statements tell a very clear story. The average gross profit on a new car, that's the price you pay minus the manufacturer's invoice, is $3,263. On a used car, it's about $2,084. Now, gross profit is useful, but it's not the whole picture. The dealership still has to pay rent, salaries, the person at the front desk, the lights, the lot maintenance, all of those operating costs that accountants call SG&A expenses, selling, general, and administrative. When you subtract all of that, the actual net profit per car drops to somewhere between $500 and $200, depending on which financial statements you look at. That's the number that makes Ethan feel like a genius. He negotiated to $50 above invoice. The average buyer is paying $3,963 above invoice. Ethan is thousands ahead of the average, and he is on the sales floor. But the sales floor is not where the big money is made. The dealership isn't done with Ethan yet. Not even close. Ethan thinks the negotiation is over. The price is locked. He shook hands. He's led down a hallway into a smaller office to just handle the paperwork. This is the most profitable room in the entire dealership, and almost every buyer walks in with their guard completely down. The person sitting behind that desk is called the finance manager. But don't let the title fool you. The finance manager is not a clerk. They're not there to process forms. They are the highest earning salesperson in the building. There's a reason they're in that office instead of on the sales floor, because that's where the biggest money is made. From those same public financial statements, here's what dealerships make in the finance manager's office. Somewhere between $2,000 and $2,800 per car, on top of whatever they made from selling you the car itself. Let's break down exactly where that money comes from. First, the loan reserve. When you finance a car, the interest rate you pay isn't just what the lender requires. The dealership marks it up. If the lender approves you at 4%, the dealership might charge you 5%. That extra 1% is called the loan reserve, and it's pure profit. Across all the cars they sell, that markup amounts to $600 to $800 per car for the dealership. Next, the extended warranty. This is the one where they hand you a brochure with a long list of everything that's covered. It sounds comprehensive. What they don't highlight is what's not covered. The profit margin on an extended warranty is between $700 and $1,000. Then there's gap insurance. This one is actually worth understanding. If you finance a car and it gets totaled, the insurance company pays what the car is currently worth, not what you owe on the loan. If the loan balance is higher than the car's value, you're stuck paying that difference out of pocket. Gap insurance covers that gap. It's not a bad product if you're financing, but the profit margin built into it is $250 to $400. After that, there are protection add-ons, wheel protection, paint sealant, car mats, fabric coating, small ticket items with $0 to $300 of profit each. They feel minor, but they add up. Total F&I profit finance and insurance from the finance manager's office, $1,900 to $2,100 per car. But the finance office isn't done. There's still the paperwork. Every car sale generates a stack of documents, and built into that stack is another $700 to $800 in profit. The processing fee, also called a documentation fee, that's what they charge you for typing your information into their system, printing it out, and handing it to you to sign. Profit on that, $400 to $650. Electronic filing and registration markup. Applying for your first vehicle registration, $40 to $90 in profit on top of the actual cost. The temporary tag, the paper you stick on your dash until your plates arrive, $20 to $50 profit. Digital contracting and notary. Someone has to notarize your signature, $10 to $30 profit. None of these numbers are huge on their own, but combine them, and the paperwork alone generates $700 to $800 in profit per car. Now add it all up. F&I profit plus documentation profit. The finance manager's office makes between $2,700 and $2,900 per car. That's before the most profitable part of a car dealership, the service center, which we won't even get into here. So let's put Ethan's full picture together. He negotiated the price to $50 above invoice. He felt great, but the dealership made $640 to $960 in holdback, hundreds more in other front-end incentives, and then $2,700 to $2,900 in the finance office on a deal where the salesman said they were losing money. That's the machine. And it ran on Ethan exactly the way it was designed to. Now let's talk about Mark. Mark went to the same dealership, same car, same month. But Mark walked in and said 5 words that changed everything. I'm paying cash. Best price. He thought that was power. Cash on the table. No games, no financing, straight deal. But here's what the dealership heard. I'm about to eliminate $2,000 to $2,800 of profit from your finance office. No loan reserve, no interest markup, no gap insurance, no extended warranty upsell. The entire F&I profit layer, the most profitable part of the transaction, just vanished. So, the dealership did the only thing it could. It made up the difference on the sticker price. Mark got less flexibility in the negotiation. The dealership held firmer, and Mark paid $12,400 more for the exact same car. This is the part that shocks most people. We're trained to think that cash is king. And in most transactions, it is. You pay cash for a home renovation, the contractor gives you a discount. You pay cash at a small business, they might knock something off. Cash means no processing fees, no waiting, no risk of chargebacks. But a car dealership is not a contractor. At a dealership, financing is the product. The loan isn't a cost to them. It's a profit center. When you take that away, you're not simplifying the deal. You're removing their most valuable revenue stream. And here's an interesting detail. You know how the finance office charges fees for everything? Processing fees, registration markups, notary fees. The one fee that most dealerships do not charge is a loan origination fee. Why? Because they want you to finance through them. The money isn't in the upfront fee. It's in the monthly payments and everything attached to them. Now, some people hear this and think, fine, I just won't tell them I'm paying cash. Keep them guessing. Good instinct, but the dealership is ahead of you. They have a series of tests built into the buying process, specifically designed to figure out whether you're a cash buyer. And most people don't even realize they're being tested. Test 1 happens before you ever meet a salesperson. You walk in, the person at the front desk hands you a clipboard. Name, address, car model you're interested in, whether you want to pay cash or finance, and whether you have a trade-in. It feels like a formality. It's not. That clipboard is the first filter. Test 2 comes about 2-3 through the process. They tell you they need to check your credit to make sure you qualify. Sounds routine, right? But they're not really checking your creditworthiness at that point. They're confirming that you still intend to finance. It's a commitment check disguised as a procedural step. Test 3. The salesperson fills out your loan application before you even enter the finance manager's office. By now, you've confirmed your intent to finance 2 or 3 times without realizing it. If you write "not sure" on the clipboard, it changes the dynamic. But the further you get into the process without committing to financing, the less flexible the dealership becomes on price. Your negotiating power shrinks at every stage. So here's the question. If paying cash costs more and the dealership is testing you at every step, what do you actually do? Professor Wealth ran the numbers, and the strategy is simpler than you'd think. Step 1. Walk in as a financing buyer. Don't mention cash at any point. This keeps you classified as a high-profit customer, and that classification gives you maximum negotiating leverage on every single line item. Step 2. At the clipboard stage, ask one specific question. What is the loan origination fee? They'll assume you're comparing their loan terms against your bank or credit union. What you're actually doing is confirming there's no upfront fee you'd lose if you pay the loan off early. Step 3. Negotiate the purchase price as hard as you can. The dealership will be more flexible than they'd be with a cash buyer because they expect to recoup the margin in the finance office. Use that expectation to your advantage. Step 4. In the finance office, negotiate the F&I products. You now know the profit margins. Extended warranty, they're making $700 to $1,000 on it. That's negotiable. Gap insurance, $250 to $400 in profit. That's negotiable too. You don't have to buy everything they put in front of you. And the things you do want, you don't have to pay full price. Step 5. Before you sign anything, read the loan contract line by line. Every fee should be listed under finance charges or loan fees. If it's not listed, it shouldn't be there. Most importantly, confirm there is no prepayment penalty. This is the critical piece. Step 6. Sign the loan. Drive home. Pay off the loan the next day or the next week. You financed the car. Technically, it wasn't for long, but you did finance it. You got the financing buyer price. You avoided the cash buyer penalty, and you paid it off before any meaningful interest accrued. The entire strategy hinges on two things: no origination fee and no prepayment penalty. If either of those exists, the math changes, and you'd need to calculate whether the savings on the purchase price outweigh the cost of the fee. In most cases, they still do, but run the numbers. That's always the move. The sales floor feels like the battlefield, the back and forth, the tension, let me talk to my manager routine. But it's not where the real money changes hands. The finance manager's office is, and most buyers walk in there thinking the hard part is over. Guard down, ready to sign. That's exactly what the dealership is counting on. Ethan didn't see it. He negotiated a great price on the surface and gave most of it back in the room behind the sales floor. Mark saw even less. He announced cash, lost his leverage before the conversation even started, and paid $2,400 more for the same car his neighbor was driving. Now you know every layer, every number, and the exact strategy to use all of it in your favor. If this video helped you see something you didn't know was there, subscribe to Pup Science and hit the notification bell. At Pup Science, we uncover the hidden logic behind money, business, economics, and the financial decisions that shape everyday life.